All right, options traders, listen up. I want to tell you a bit about public.com. But first, have you ever actually thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or pre-contract fees. And in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 option contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. So to recap, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for options trading, and start earning up to 18 cents per contract traded only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only.
Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I am Jason Hall, joined by my good friend, none other than the voice of the people, Jeff Santoro. Hey Jeff.
Hey, how are you?
I'm good. I'm busy, a lot going on, starting to get into spring kids sports season, which its calendar's filling up.
Yeah, it feels like when I get out of every kind of phase in the year, I'm like, oh, I got through that. And then I realize there's another phase coming.
That's right. That's right.
I'll just never not be busy. I'll always be busy. That's
right.
life.
But busy's good. Busy's good. That's
kind
of the point. You know, that's kind of the point. So, all right. So this is one thing I think is kind of interesting. It feels like the cadence of when we record the podcast now means that this quarterly show that we do for the portfolio contest seems like it comes out a little bit later than normal. So we're recording this on April 2nd, but this is the update for the 2024 Investing Unscripted Portfolio Contest.
Yes, we are recording this before the first episode of the month drops, but this is the first time we're at the microphone since the quarter has ended. So I spent the weekend crunching the numbers and updating the spreadsheet. If you check out the show notes, you can see the entire spreadsheet that we are referencing with all of the different portfolios. There is also a link at the top to the episode where we revealed all of these. So if you missed that, if you're new to the show and you want to go back and listen to the episode where we announced all this, you can go back and do that. But today we are going to talk about Q1, talk about some of the trends we saw, who did well, who didn't, what stocks did well, what stocks didn't, and ask each other some questions about what we're thinking the rest of the year might look like. Before we do that, real quick plugs for everyone to follow us on social media. You can find us on all of the apps. You can email us anytime at investingunscripted@gmail.com. Please check out our YouTube channel. Please subscribe to our newsletter. There is so much Investing Unscripted content that if you're a huge fan, it should fill your whole day. And lastly, the most important thing and the most helpful thing is for people to continue to give us reviews and ratings on the podcast apps. Our number one goal is to have as many people hear the show as possible. So anytime you can take a few minutes to do that, it helps the show get out there. And with all that said, Jason, let us dive in here.
Let's do it.
All right. So I think what makes sense is let's start with the headline numbers here. So as a reminder, every quarter we announce a winner for that quarter. So this is a year-to-date winner as well, because it's just the first quarter of the year. And both of us have committed to donating to the charity of the winner's choice. So the Q1 winner for this year's contest was Mitch Fatel, a comedian and one of the first guests we had on back when we started the podcast last year, or 2 years ago almost. His portfolio was up 27% in Q1, and he also was the winner for March. So we'll just mention that while we're here. He also, just for the month of March, had the portfolio with the biggest gains. So Jason, you and I will be donating to the Wounded Warrior Project, which was the charity that Mitch chose. And we encourage all listeners to do the same. If you are willing and able to donate any amount of money to that charity, we can put we will put the link to that in our show notes and our transcript as well. So you can easily click and give some cash.
This one came down to the wire too.
It was really close. Yeah. He just beat out Nick and Casey Rossalillo's portfolio. They came in a close second. We'll talk more about them later. But Jason, you reached out to Mitch to get live a hot take, a line, a commentary on his victory here.
I did. I reached out to his people, and his publicist followed up with me and provided me with a quote.
Yeah, could you
They
read the
reached
quote?
uh, they reached him on his private island that he paid for with the stocks that he put forth for this portfolio. If this and this is again Mitch's words, if this proves anything, it's that someone who can barely cut his own meat can pick stocks.
Beautiful.
And then he sent a follow-up.
Oh, okay.
Can you let me know what I picked? I forgot.
So
Yeah.
it's funny, as you would expect from a comedian. And, but it's also, I know he's kidding, or maybe he's not kidding about, can you remind me what I picked? But that's kind of part of the fun and the point of this whole thing is that, you know, no one's expecting to declare anyone the world's best stock picker after 3 months. And to some degree, you could pick a random 5 or 6 stocks and do well or not do well in any 3 month span. That's sort of the randomness of the market. I'm using a hot take from Mitch regardless.
Absolutely.
All right. So Mitch is the winner. Wounded Warrior Project is the charity. We encourage people to give. But Jason, let's dive into the results across the board here and just talk about some high level things. So I want to hear your thoughts on these headline numbers here. So the best stock for the quarter was NVIDIA,
Yep.
which was up 82% from January 1st to March 31st. What did you think when you saw that?
It's unsurprising, but at the same time, it also would not have surprised me if NVIDIA was down 50%. The bottom line is that say whatever you want about valuation, say whatever you want about bubble, say whatever you want about AI. The business keeps delivering. They keep growing. They keep reporting more orders. They keep reporting higher demand. They keep reporting better margins. Like all of the things that you want a business to do are delivering, right? So I guess that's about it really. It's just unsurprising.
So it's interesting you say unsurprising because I know this is going to sound like I'm hedging, but to me it was unsurprising, but also kind of surprising.
Yeah.
And
No,
what I
that's a
mean,
better way to put it.
yeah, and what I mean by that, and I think you're getting what I'm putting down here, which is I would not have picked Nvidia, even though I think it's a fantastic company and I own it and I think it's going to be great and do well, simply because of the run it had been on in late 2022 after all the AI results started coming in the second, third, and well, we didn't get Q4 results yet, but second and third quarter of last year. But then there it went on another 82%, which it reminds me of that expression. And I know this is about the market going the other direction. The market can stay. What is the expression about longer than you can be insolvent? Or
Can stay, markets can stay irrational longer than you can stay solvent.
right. Yeah, that's the quote I was looking for.
Yeah.
And anyway, it reminds me of that, but sort of on the flip side, right?
Well,
Like
but
it,
it's exactly why I would never short a stock like NVIDIA. And yeah,
yeah,
I'm long NVIDIA. I own NVIDIA, right? I think
same.
Jeff, you own some
Yep.
too. You just when the animal spirits have a stock or a theme or an idea, it goes until it doesn't go anymore.
Yeah. And this is one again, I know it's bubbly and there's obviously some enthusiasm baked in here, but it's legit too. Companies are going to be spending more money on AI and
Yeah.
they're going to buy chips to do it. And right now the chips everyone wants to buy to do it come from Nvidia. So for as long as that's the case, I think you're going to see these results. I think the question is, when does it stop? Because at some point it will, whether it's because there's enough out there or another competitor comes up and has a chip that people want to buy. So that's why I wouldn't necessarily add to it right now, but I certainly wouldn't short it or sell it. All right. The worst performing stock, and this will come as no surprise to anyone who's listened to our podcast regularly. It was once again Outset Medical, which was down another 59% in the first quarter of 2024. And Jason, I have to start to wonder if I'm going to look back at myself in this phase of my life where I was still a big fan of Outset Medical and think like, did I just fall for a hype stock? Did I fall for a story stock? Will this end up being a massive disappointment in my portfolio, or is there still hope for this company?
Yeah. Well, to me, this is a perfect example of like the unknowable stock, right? Because the reality is that all the seeds are still there for wonderful returns. But for a long time, you could have said the same thing about Transderm,
Oh,
Dermtech,
Dermtech.
Dermtech, right? It's a disruptive technology. potentially upending an existing product or service in the healthcare industry that had been the de facto gold standard for forever, that everything about it looks better. Everything about it looks better for patients, quality of care, lower cost of like all the stuff looks better, but it requires massive change, right, in the way that an industry operates. And DermTech they're still around. I haven't looked in months, to be honest with you, but
Yeah, I haven't either.
it wasn't the big thing, right? And we just don't quite know that yet with Outset. The market's pretty clear in what it's voting right now.
Yeah.
Um,
For a while, as it was falling all throughout last year, I kept thinking to myself, well, the results aren't fantastic. So I could see, and maybe it was overvalued when I bought it. And therefore, this is just a little bit of a correction back to what's a reasonable multiple for a company that's unproven and still in its early stages. But it just keeps falling. And
yeah.
it does make me wonder if I was just completely wrong about this one. I will say this, it's made me think a lot about position sizing for
Mhm.
more speculative position, more speculative stocks because I have enough outset in my portfolio where if it turns it around and, you know, becomes a 10 bagger, I'll be very happy. But if it continues to go to zero, it won't have any impact on my future. So I
Right.
feel like I have like the right amount allocated to it. Oh, and by the way, if a year from now it's up 100%, A, it's still going to be down for me. And B, I'll have a lot more data and information and conviction to add more if I feel like the story has changed. So I think that's why I can laugh about it. Yeah. Because I didn't make it
Yeah.
like a 6% of my portfolio or anything crazy like that. But yeah, this has had me scratching my head for quite a while now.
Jeff, I hope the one lesson you learned from it, and this is one that I've had learned before. Yes, despite having learned it before, have made mistakes like DermTech with position sizing, helping offset the damage, is healthcare and biotech startups are really
Hard.
hard.
Hard. Yep.
Super hard, like an order of magnitude harder than other less regulated, less entrenched player businesses. So,
Yeah.
yeah.
And it's just I would say it's hard generally, like, even with the big established companies in terms of long-term, like, beating the market, but it's especially difficult for these tiny upstart not the company, I mean, upstart biotechs that are at the very early stages, like you said, trying to disrupt something. I'll talk more about Outset later because it's one that I have on our notes for a later question, but it was the worst performing stock, so we had to mention it here. All right, so here's some other headline things that I'll just throw out here. I don't know that we necessarily need to discuss them, but I do want to give some props to some other people who played our portfolio contest here. So these are the portfolios who beat the market in Q1. So the S&P 500 was up 10.6% through March 31st. And these are the people who picked stocks that have so far this year beat the market. So we have Mitch, obviously we mentioned him. Nick and Casey Rossalillo were right behind Mitch's portfolio. They were up 26% with theirs. Tyler Crow, guest on the podcast and frequent YouTube video collaborator with you, Jason, his portfolio was up 11%. And then we had 4 listeners who sent in portfolios who beat the market as well. So Jamie was up 22%, Lance was up 21%, Teo was up 17%, and YouTube user Anne Marie Lamb 7748, who we know only by her username,
Right.
was up 12%. So nice showing by some of our listeners here.
Yeah, I think they've all proven that they are more qualified to run large cap, actively managed ETFs than most of the managers out there actually doing it. So, guys, get your CVs ready, put in your applications, make some real money.
Yes, I know you're saying that tongue in cheek, but it is interesting. Like, again, we said this all throughout
I'm
last
saying
year.
it tongue in cheek, but the majority of them underperform their index year in
Right.
and year out.
But I don't
So,
want people to misunderstand you. This is 3 months,
oh yeah,
right? This
yeah.
isn't 3 or 10 years, right? So we'll see how the next quarter goes. Okay, so
Hey, I believe in you people. You can do it.
Jason's the believer. Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on more than 1,500 stocks. Want to see Netflix's average revenue per member over the past 10 years? FinChat's got it. Do you like to track YouTube's advertising? They've got that too. Want to see how much of Celsius's revenue comes from Costco? You guessed it, they've got it. The breadth of FinChat's segment and KPI data is truly one of a kind. I use FinChat all the time and I love it, especially for checking out the KPIs of all the stocks in my portfolio. To get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. So, as you looked through the entire portfolio, all the different, I'm sorry, the entire contest, all the different portfolios, what was the
Right,
biggest
the
surprise?
universe of stocks in the portfolio contest.
The universe of stocks in the portfolio contest. All right. As you looked through the universe of stocks, what were your big takeaways? Any big surprises? Any contest wide noticings that you had?
So I think we're gonna subtitle this episode "Wherein Jeff Dunks on Jason," because I
All right.
will
So you're
say,
you're shooting yourself before I get a chance to shoot you. Is that what
you're
you're
damn
doing?
right I am. Of course I am. My portfolio is easily the worst performing. I've got 3 of the 10 worst performing stocks. There's probably 100 stocks in this portfolio in the contest. It's a lot.
I haven't counted individually because some repeat. We have some repeat.
Yeah, but I would say it's between 75 and 100. It's a lot of stocks, and I've got 3 of the 10 worst performing in my portfolio. That's that's remarkable. That's just remarkable.
I think if you might have had trouble doing that if you tried.
Yeah, no, that's the thing, right? And well, in a way I kinda did try because, like, I intentionally went through my portfolio of stocks that I own and picked not cherry picked some, but I, like, focused on the ones that had the worst 2023 that I thought had really good chances to rebound based on their business and what they were doing and tailwinds and that kinda stuff. Like you said, it's only been a quarter, but I have been I have been 100% wrong, right? So that's like that's the one thing that personally has stood out. The other thing that's been surprising to me is how well the semiconductor stocks have continued to perform. Nick and Casey's portfolio, they run the Chip Stock Investor YouTube page. And I want to mention this too. Anybody that doesn't subscribe to the newsletter, on a show like this episode, the newsletter is really handy because we send the transcript. We email a copy of the transcript when we release the podcast to newsletter subscribers, and it'll have all the links for these folks and what they're doing, and links to episodes when they came on the podcast with us. So you'll have all that right there. So that's one thing that's useful. But I mean, the reality is that a lot of the semiconductor industry is still kind of in a lull. Like industrial demand is way down. Automotive demand is not great. The EV industry is kind of in a mess right now, and EVs call for a ton more semiconductors than traditional vehicles do, which still like your average new car with a gasoline engine has like between 100 and 200 semiconductors in them. But the industry, besides like demand for artificial intelligence, and we're starting to see a little bit of recovery in smartphones, it's still not great.
Yeah, as I've read through transcripts and SEC filings for companies related to the semiconductor industry, it is stark to hear the commentary by management because it's mostly here's how great AI is, and then it's here's how bad everything is. You know, that language they use of like it was, impacted by this and offset by that. It's all like impacted positively by AI and offset by all other semiconductor things. So I think that's something that I agree. That was interesting to see. I think what jumped out to me, well, two things. One is that nobody has a portfolio where all the stocks are in the green, right?
Yeah,
So like even Mitch, who and the Rossalillos who are crushing it, each have two stocks in their portfolios respectively that are in the red and more that are trailing the market. And I think that's a good reminder that no one bats 1,000 and that you
right.
can do really great things as an investor with a Mets batting average, like sub 300.
I'm batting
Um,
1,000, Jeff.
yeah,
All of my stocks are
you're
down.
batting 1,000 in the wrong direction. Yes, you're right. Yes, you are the only person who's entirely in the red. So congratulations on that. But I think the other thing that's
So,
going to
Jeff,
be
here's what I'm doing.
yeah.
I think I've talked to you about this offline, but last year I proved that I can be the best winner, right? I was the best. I mean, it was like I won and it wasn't even close. So I think I can lose by more than anybody.
Hey, you know what? You set your goals and you reach for them. I'm
That's right.
proud of you.
Aim low, pal.
So one of the things that I noticed last year as we went through the year was how volatile and crazy
Yeah.
some of the stocks were.
Right.
One month up double digits, another month down double digits. So like all the way to 0 and then some. And same thing quarter to quarter. And I'm curious if we're going to see as much volatility in this year's contest over the course of the year as we did last year.
Yeah.
And because I remember in January, February of March last year being very surprised at how many of the stocks in the portfolio contest were up because we all still had the horror of 2022 in our minds.
Right.
And now that we've been through like a year of a decent market, the market still doesn't feel as surprising to me as it did last Q1. You know what I mean? Because like it's been good for a while. So I am curious to see how that plays out. So that was another thing that kind of jumped out at me looking across the whole contest.
Yeah, and things can change quickly because just, again, going back to last year at the end of the fourth quarter, my portfolio was up 7% and the unportfolio was up 33%, that's bad, right? The unportfolio, the goal was to pick the stocks that were going to perform very poorly. And the unportfolio basically went sideways for the rest of the year, even though two stocks went down a ton, like they were supposed to. And then two stocks went up a ton, which they weren't supposed to. And then my portfolio ended up just going crazy as tech stocks took off. So
Yeah,
you just don't know. Like it gets back to that same theme that, you know, a lot is going to change between now and December 31st.
agreed. It'll be fun to watch. And we'll do this review show every quarter as close after the end of it as possible. So in 3 months, we'll do this again, see where we land. All right. I want you, Jason, go. You don't have to talk about every stock in your portfolio because you have one of the portfolios with the most stocks in them. But maybe go through and talk a little bit about what you learned or wondered or was impressed by or were worried about any of the companies in your portfolio. I guess specifically related because like everyone reported earnings between when the contest started and now. So we have more information now than we did in December when we picked them.
Yeah.
So as you go through your
We either have full
portfolio,
year fiscal year earnings or we've gotten their most recent quarter if they don't
right?
follow the calendar year.
Yeah,
Yeah, so
most
we
of
have
them
both.
are Q4 slash 2023 full years, but some are not. So just
Yeah.
what jumped out to you as you went through the earnings of the companies in your portfolio?
So I have 3 stocks that are all in the renewable energy business. I've got Enphase, which is residential batteries, and then the, electronics that go on solar panels, and, STEM, which does, like, big batteries and software, and TPI Composites that does turbines. The blades that go on turbines, they make the blades. They're a contract manufacturer for basically all of the turbine manufacturers, and those stocks are down. 2 of those are down a lot. STEM and TPI are down 44 and 30%, and then Enphase is down, like, 8%. And it's just a reminder the pain of cyclical industries, because right now we're in the midst of the biggest downturn for solar in a very, very long time. The wind business is pretty weak now. These are interest rates have gone up, so all of the big capital spenders are kind of reevaluating. Even though there's huge incentives with the Inflation Reduction Act, it takes these markets a long time to turn, and the guidance continues, like all of these companies, like their guidance for the current quarter is that it's just gonna get worse. So the market still is waiting for some sign that things are gonna turn, and I think these could end up being from these low points, these could be 3 of the 10 best performing stocks in the whole contest by the end of the year from
Or
this low point.
or they could be on the outset medical path and
Yeah,
drop
yeah,
another
I mean,
50%.
maybe of these 3, I think maybe STEM because, like, they could run into capital issues. Um, but in phase, I would push back on that because their business is such high quality. But to your point, like things can stay bad for longer than you expect, right? What about you?
Well, I'll do mine in a second, but, like, just to piggyback on what you just said, it reminds me a lot of the way I felt during 2022 when the market was going through that prolonged downswing, that constant thing of, like, "Okay, is this the day I should buy a lot more of this stock, or will it be lower in a month?" You know, and it's like, you don't
Yeah.
know.
Right.
So, I I think it goes back to, like, the toolbox and having some
Right.
sort of framework, plan, strategy, amount you're willing to invest in a specific company, position sizing, all that stuff. It's like you have to kind of prepare for those things when the market is sort of at its normal,
Right.
so that when it does something crazy, whether it goes up a lot in a short period of time or tanks, you're not panic selling or panic buying and trying to figure it out as you go along.
Well, there's
Um,
another part of that too. I think it's important to mention too, bringing up the toolbox when we get caught up in trying to get the perfect price or avoid, the falling. Was it the catching a falling knife or whatever it's called, like all of those things. Those are such short-termism mentality ideas. This is where valuation comes into play as being useful, even for stocks that valuation can be really hard to do because they're not cash flow positive or any of those things. But like you can have some idea of like a range of price that makes sense and then overlay that with your long-term goals, right? You're not buying this stock because you think this is the bottom. You're buying it because you think in 5 or 10 or 30 years, it's going to help you have the wealth you need to have financial independence, right?
Yeah.
And remembering that, I think that's so important.
Don't forget your goals.
Yeah,
Don't forget your goals.
right.
So, one of the ones I want to talk about in my portfolio, because it's one that I know you own, is Boston Omaha.
Yeah,
And the reason I want to talk about it is this is a company that I've followed probably closer than a lot of other companies for a couple reasons. It's one of the earliest ones I bought that I've
yeah.
still held on to. And it's one that I cover a little bit for the work I do at the Fool. And I've been frustrated the last couple quarters with the lack of information that comes out from Boston Omaha. They're a conglomerate, just in case anyone's not familiar with it,
They're a tiny conglomerate.
tiny conglomerate. They get compared a lot to a mini Berkshire Hathaway, which is completely unfair. It's only because they're based in Omaha and one of the directors, one of the co-CEOs is vaguely related to Warren Buffett. And they're trying to do a similar thing, but there's no reason they should ever be in the same sentence. But they pattern themselves after Berkshire in the sense that they don't do press releases, they don't do earnings calls, they just drop the 10K or the 10Q and they do an annual letter and that's it. And that's great when you're freaking Berkshire Hathaway, but it's super frustrating when you're a tiny conglomerate trying to get your footing and convince investors that your business is worth investing in.
Yeah.
And every quarter comes out and the numbers are fine. I looked at Q4, I looked at the full year results and everything was good. Everything's growing nicely in the business, but they made a decision to close their asset management part of the business. Fine. Businesses make decisions like that all the time. But other than saying, basically, this isn't working out, so we're closing it, there was no other color or commentary. Now, their annual letter usually comes out in April, so there's a chance that there's going to be a little more information in that.
Oh, there most certainly will be.
Yeah, but even that though, like I don't know how much. It might just
Right.
be an extra couple sentences beyond what they already say. So it's like that's where I'm frustrated. I'm not necessarily frustrated with the business
Yeah.
results. It's the lack of it. It makes me. I have a hard time building higher conviction because
Right.
other than the numbers that they're putting out, I don't have a lot to hold on to. I don't know.
It's hard to
Um,
evaluate a business like this without more context about what they're doing and the
yeah,
decisions they're making. Because especially Jeff, you and I were texting about it. In full disclosure, I can say this because we're recording this on April 2nd, so it's going to be a week before it comes out. I actually added to my Boston Omaha position today. We got the 10K Friday, last Friday after the market closed, I believe, or was it earlier this week?
no, they released on like Tuesday of last week.
That's right. That's right. We
They
were
usually do a
expecting it the
Friday,
Friday.
so it was odd
We
that
were
they did it on
expecting
a
it the Friday
yeah.
before, but they finally dropped it. And so anyway, it came out and so it came out Tuesday of last week. I read the report. I did a show for the Motley Fool too for members taking a look at it. So I really took some time, focus on kind of the key things and like to think big picture about what is the real thesis here? And has the thesis really is the thesis busted? Right?
Mhm.
Because first of all, the core part of the thesis for Boston Omaha is you've got these 2 co-CEOs that founded the business, took it public, I think with a reverse merger. I don't think they did a traditional IPO. So they acquired a shell company, renamed it Boston Omaha, changed the ticker, which they've actually done twice. They changed it to one thing and then they moved it to the New York Stock Exchange and changed it to the current ticker. So they did an IPO in the traditional manner. But the whole thesis is you've got these 2 young guys that had some experience in allocating capital prior and some investing success.
They both ran
Now
their
they're
own
running a publicly traded
businesses.
company. Combined, they own a substantial stake, so they got tons of skin in the game, and you're betting on their ability to allocate capital to their core businesses, so the insurance and the billboards and the cable, the broadband business that are these at least two of those are really high capital expenditure businesses where you put a lot of capital out, but you have assets that last a long time and generate a
Right.
bunch of cash flow. And what you're really betting on is then they're going to take that cash flow, that capital, and then they're going to go find something to generate better returns on. And it's really hard to tell that right now because, well, the needle gets moved, like with the asset management business. It feels like they told us last year that they were going to stand up this great asset management business, and then they just turned it off. And it's really been around for 5 years. They finally found some things they wanted to do with it, but I don't think they could find investors that wanted to support it. I think it's
Right.
the thing.
Yeah, it was
Um,
a bad time to start asking other people to invest alongside of them.
yeah, yeah. I mean, the market's gone gangbusters, and you get 5% on treasuries, so it's a tough. Like all of those things combined, make it a tough time. And then, so I really try to internalize all of that and process and think about it. But then, like you were saying earlier, the core business is doing fine. Growth is solid. The business generates positive cash flow. They generated free cash flow this year, and it's traded. The stock's trading for like a $2 per share discount to book value.
I think part of it too is, and this goes to what we talked about previously with the need to do something or to have information.
Right.
So for a while, they were acquiring bolt-on billboard companies, bolt-on fiber companies, bolt-on insurance company. They were adding in the industries they're already in, they were adding other companies and buying more of them. So you'd get a 10Q and or there would be a press release. They bought this billboard company and it added 5,000 billboards to their portfolio, right? They haven't done a lot in the
Yeah.
last several quarters. So, and at the same time, the stock has just sort of trickled down over time.
Right.
So
Right.
every quarter, it's like I find myself wanting to be surprised with like some information, like,
Yeah.
oh, this thing happened, and now
Right.
it will be better or worse. But it's just like every quarter is like Groundhog Day. It's just like everything's fine.
Right. And the
Yeah.
thing to me, Jeff, this is the last thing I'll say about it, and we can move on. I don't want to turn this into the Boston Omaha episode, but so I think anybody that's followed me for any period of time knows that I'm a pretty big fan of Brookfield companies, and it starts at the top with the with Bruce Flatt, the CEO there, and the leadership culture that they've built across all the Brookfield businesses about capital allocation, where they move at their pace, not the market's pace. They will sell an asset when they've already figured out, okay, this is not growing at our, like, it doesn't meet our hurdle rates anymore. So we'll put word out there that we're willing to sell it. And it may go a year and they don't sell it. Or it out of nowhere, it feels like they sell it quickly because some big pension fund wants the cash flow and they pay the multiple that they want. And then it may be 9 months or a year before they find the right asset to redeploy that capital into. They're not trying to hit the market's quarterly number. They're trying to create value, and things like what you were just talking about with Boston Omaha, like their kind of cadence of acquisitions and expansion slowed. To me, that reinforces that they're probably pretty good with allocating capital because they're being disciplined, right?
Yeah, and I would say, you know who else's cadence of acquisitions has slowed dramatically over the last 4 years?
The
Berkshire
great
Hathaway.
the great uncle of
Right.
one of the co-CEOs.
It's the
Yeah,
exact same feeling people have
yeah,
when, like, 13F day comes and everyone's like, "What did Berkshire buy?" Like, and it's like, "Oh, not much."
yeah,
Like,
yeah,
alright, so let's move on. Yeah, we don't wanna spend too much time. So, there's only 2 others in my portfolio that I just wanna say a few things about because one is something we talked about earlier, and one is another company that I know you own, and I'm curious your thoughts. So, just circling back to Outset Medical for like 30 more seconds. Only at the year end do they report their installed base of their Tableau devices. And I think this is worth knowing. And this is why I still have a little bit of hope in the company. So in 2023, their total installed base of their devices was up 34%. That's pretty good in a year when they had a voluntary stop sale on one of the versions of their device because of an FDA issue and just general economic cautiousness by companies buying things, right? Their acute and subacute providers were up 27%, and the home install base, which is where I think the most exciting part of the future of the company is potentially, was up
yeah,
63%. Now, that's probably off a pretty low base, so I
right.
can't get too excited.
No, that's a number you wanted to see double last year.
Yeah, but 63% is not terrible. I guess you're right. Yeah, that is another way to look at it. Like maybe it should have been 200% off the
Right.
small base. So those are, I mean, I'll have to wait a year to see. If a year from now those numbers are the same or lower, that will be a big worries, red flag, yellow flag to me. But
Yeah,
I
you
don't know.
won't still own this stock if that's the case in a year.
Yeah, probably not.
Somebody else will own the business.
Yeah.
Hey, everybody, we'll be right back, but first, a word from our sponsors.
Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. All right, the other one is EPR Properties, which is a REIT that owns a lot of experiential real estate. And I read their quarterly report and their earnings call, and I was actually pretty encouraged
Yeah.
that a lot of the biggest issues around their exposure to movie theaters was behind them.
Well,
And
rents are less than 40, it's less than 40% now, and I think it was like 47%
yeah,
a
so
year,
it's
year and a
it
half ago.
right. It was two things that stuck out to me. One is that the theater industry is recovering. It's not anywhere near where it was prior to the pandemic, but it's better.
Yeah,
And that they're actively trying to diversify away from that exposure. And
right.
the stock's been pretty beat down. So it feels like if they're on the upswing of that, it does make me wonder if right now is a pretty compelling time to think about adding to my position. So those were two more that jumped out to me in my portfolio over the first quarter of the year.
Yeah, I think I bought more EPR today,
You think you
filling out
did?
my
Like
position.
it was today, so you should like know.
Jeff, I sent you a screenshot. I bought a lot of stocks today. It was my bender. I went on a bit of a bender today.
Yeah. Raccoon on meth Jason hit the buy button today.
Stocks raccoon on that.
That's right. Stocks raccoon on meth. All right. So let's as we turn the page away from our own portfolios, or actually no, let's stick with our portfolios a little bit longer. What is the stock in your portfolio that you would still buy today if we were starting this contest right now?
So I bought two of them today. I bought Boston Omaha, and for the first time in a long time, I added to my QuantumScape position. Wait, did I? Yeah, why don't I
You
remember?
did. You did.
I did. Okay. Because I was thinking about it and I'm like, no, I want to wait for something more material. And then I'm like, they just promoted a new guy to CEO, and the co-founder who's CEO is just moving up to the chairman role. That's the material thing.
All right. So if all right, but you're hedging a little. If you had to pick one stock in your
Okay.
portfolio,
So if I had to pick one, probably SoFi. I think probably SoFi because it's a combination of, so with all the other ones, there's little warts that are going on Wolf Speed. We've talked about like industrial demand's down, and the weakness in EVs that's a real problem for Wolf Speed. Renewable industry's a mess. QuantumScape's still a startup. SoFi's showing it. Like they're doing it. They're going to make money this year. They're going to be gap profitable the full year. And the stock's like, I don't know, 10 times, 12 times expected earnings per share in 2026, like gap earnings per share. So I'd say SoFi.
all right.
What about you?
Mine would be EPR, which I sort of just explained why a minute ago. But as I look through my portfolio, it's probably the one I think is in the best position to be added to. I mean, I
Yeah.
own all of them, so I have some level of conviction in all of them. So yeah, I would go with EPR Properties. All right, what is a do-over stock? So if you're starting the contest today, you would not have included. And you have to give me a business reason. You can't just say because it's down.
Yeah. No, probably Outset. I know that might seem a little unoriginal and maybe biased because we've talked about it so much, but of this group in my portfolio, it's the one that I know the least, and I did it just because it was down,
Right. I
right?
was going to say, I remember you specifically picked that just to sort of bottom feed.
Yeah, and with the rest, I think broadly, maybe may STEM, but I know STEM pretty well, and I know the demand, like the industry demand for what they do is giant. If they can just kind of execute a little better, I'd say Outset because like we just talked about with that like that one number with the home units, that sure it grew 60 something percent, but double or triple is really what we would have liked to have seen. What about you?
I mean, if I was going to pick like based on price, I'd say Outset because obviously that was my biggest mistake. Actually, the one I would probably not pick, I struggle with this one. So it's Health Peak Properties, but the ticker
Yeah,
changed to DOC. It's just I even forced myself to read through the 10K again just to sort of wrap my head around the business a little bit better. It's a REIT that specializes in healthcare and medical facilities, which I think is a pretty resilient area in the world of REITs in my mind. I think to myself, because those are very specific buildings, right? Like if a big pharmaceutical company leaves a campus, you're not going to move an Amazon warehouse. Amazon's not going to take over the building. You know what I mean? Because there's specific things, and vice versa too. If a big biotech's looking for a facility, they need one with certain specifications, or it's a huge renovation. So I feel like that distinguishes them a little bit. And I check every quarter. I look at the results, and I'm just like, everything is like, it's just boring. It's like everything's fine. Like there's no red flags, there's no green flags, and the stock doesn't seem to react or go anywhere. I don't know. It just bores me. I'm not interested in it. I picked it to force myself to learn more about it.
Right.
And as I have, I've become less interested. So purely from a do I care about this business standpoint, I would probably do over Health Peak Properties.
Yeah, well, I think the thing too with Health Peak is Health Peak and Physicians Realty merged,
Yeah.
and
That's
that
why the ticker
closed in
changed. And
March. That's a pretty big merger of two. Like, as much as there's growth and potential, it's also not a great industry. So even though these are mostly like doctors' offices, like a lot of office space, and then like some biotech space too. It's not like hospitals and that kind of thing. I don't think
right.
that's a part of the portfolio. Hospitals are terrible business, right? You don't want to own a hospital and lease to a hospital operator because they're probably going to go bankrupt, right? It's a tough business. It's still just there's a ton of inventory right now, right? And we've seen the big pullback in biotech investment over the past couple of years that's been tough on these businesses. So it's kind of in the too hard pile for me right now.
Yeah. Yeah, and it's one I bought on total borrowed conviction too. I never
Yeah.
really had it's in my portfolio because of that. But I've said before, I'm trying not to sell anything in 2024. I'm trying to
Right.
force myself to like own my mistakes and learn more about them. So yeah, it's just not one I'm super interested in, not want to have a high level of conviction. All right, last question before we wrap things up here. If there a stock anywhere in the contest that has gone up that you think is a buy right now? And
So
I
I'm gonna
ask
have
and I
this.
ask that it's gone up because I want to challenge you to think about like the idea of adding to a winner. So you
Yeah.
can't bottom feed again. You have to pick one that's done well.
Yeah, no, I love this question because I think this is a time to be doing exactly that, right? Because it's a good time to, like, reforce yourself to think about your goals, and I'm gonna say probably CrowdStrike, even though it's probably overvalued. This is best of breed in a company in an industry that's gonna continue to expand and grow. They've gotten to scale, it's become a cash cow. Especially if you're looking 5 or 10 years out or more, I think the potential for just incredible market beating gains from here are wonderful. You know, you could look at a company like Adobe or Microsoft over the past decade, and there was at any given point, you're like, "Well, this is a really big company. How much can they really grow?" Stock's a little bit pricey, and still looking back 10 years later, be like, "Man, that was smart." I think that's CrowdStrike right now.
I'm mad you took CrowdStrike because that probably would have been my pick too. Because
It can be your pick too.
I'll think of a different one too. But the reason I say that is because it's one of those companies where it's like every single quarter, I look forward to seeing the results. I open the results, I read the results, and I'm just like, it's great. It's like they impress me every single quarter. And even when it's like a less than stellar quarter compared to other ones, it's still really, really good. And it does feel like they're one of those companies where you can make a mistake buying at a higher valuation because I think they have a very long runway of growth still ahead of them, and then that scares me and I worry that I'm wrong. I would probably pick them. All right, let me think of a different one though.
Well, while you're thinking, I would say my next one, and this may be the one that you'll go with. And I was very tempted to go with Taiwan Semiconductor, TSMC.
So, before I asked the question and changed it to one that has gone up, I would have picked Enphase or maybe Transmedics because I love the story of
Oh yeah.
Transmedics,
Yeah, I'm glad
and
you mentioned that one.
Enphase because actually, you know what? No, Transmedics did go up. Yeah. So if I was gonna pick one that went down, I'd go with Enphase because I feel like they're
I
gonna
think it
turn it
was down at
around.
the end of the quarter.
Is Transmedics up?
No, I think it's down like 6% because I was
Oh,
looking because it's in Mitch's.
yeah, it's in Mitch's. That's one of the few that's down.
Yeah, it was down 6%. And I remember thinking it's so funny looking at his portfolio. The two that are down are Transmedics and Mercado Libre. Mercado Libre's been my best performing stock by wealth creation of all.
Yeah.
And Transmedics is one that I deeply believe in.
So I think I would go with, and I'm gonna put my mouth where my money has just been. I would actually go with Celsius Holdings, and
Yeah.
and here's why. It's gone up a lot. although in the last couple months it's sort of cooled off a little bit. It's one that I had at the top of my list of stocks I felt like I should add to for a really long time, and I just couldn't bring myself to do it because there's still part of me that can't believe an energy drink company is going to be a long-term sustained winner, even though we've seen it happen with Monster Beverage in the past.
But we've only seen it happen with Monster. And that's
Agreed.
the point.
But
It's kind of
again, I got to a point where I said to myself, do the thing that you say you believe in, which is adding to winning stocks
right.
and having the guts to put enough money in that it's like a reasonable allocation in my portfolio. Because as I was hemming and hawing over all these months, I think my total cost basis for the company was like $330, which is, in
You're
my
not 13
portfolio.
years old, Jeff. Let's
Yeah.
put some real money here.
So
Yeah.
I finally did it a couple weeks ago. I brought it up to a much more reasonable allocation in my portfolio, and I'm happy there for a while. I'll see how it goes. But because I just added to it, and because I did have that a struggle, I will say that that's my pick. All right, last question. Your portfolio will win Q2 if you you pick
If
all new stocks.
if the yes, yes. No, it's my portfolio wins Q2 if we start seeing better outlooks for renewable energy. If
Yeah,
we
you
start
are
seeing
pretty heavily allocated there, right?
huge, the three of the stocks, and it's three of two of my worst performing, which is saying a lot. I mean, if there was like one binary action, it would be just that better outlook for renewables. What about yours?
So my first thought was if Outset turns it around, but then I realized I can keep that as a loser and still have a fine portfolio because I have enough stocks. I think for me, it's about one of two things would have to happen. One of the stocks that has the potential to really take off does. So CrowdStrike has another great, last 3 quarters, or Dreamfinder Homes, which has done really well for me. It's a home builder. If they really take off, have some good results in the next couple quarters. If one of those really kind of hits, I feel like I could pull ahead. Or if all the ones that are sort of break even-ish just have good Q1 results
Yeah.
and go from down 3 to maybe up 5. Do you know what I mean? Like if my batting average gets a little higher, I feel like that might be enough to get me over the edge too. But it's probably more likely that CrowdStrike takes off or something like that and that carries me over the finish
If
line.
if we see a stock market correction in the second quarter, my portfolio could be down 50% halfway through the year.
Yeah. Well, and I meant to mention this earlier when we were talking about like takeaways for the whole contest. I was struck by how many people ended Q1 around break even,
Yeah.
up 1, down 2, up 3, down 4, something, around break even. And I'm interested to see how that shakes out. Is this a year where we sort of middle along and people are always kind of around 0%, or does it does it get a little more binary as time goes on? All right, and then the final question, Jason, then we will wrap this review up. Whose portfolio do you think will win Q2?
Ooh, I think mine will. I'm kidding. I'm kidding. Um,
I like the confidence.
yeah, this is maybe Gillies.
Yeah,
I think Jim Gillies could do well because he's got some energy exposure, and then he's kind of taken a little bit of a beating because of AI. Chegg, for example, is down a ton because
yeah.
everybody's convinced AI is going to put it out of business. So I wouldn't be surprised to see a bounce back like that. What about you? Who do you think?
So I think it'll probably be one of the audience members because that just seems to be how this goes. But if I had to pick I actually think it's going to be Nick and Casey Rossalillo. I think that their decision to build a semiconductor portfolio was actually really smart. And I think they were smart about the specific companies they chose.
Yeah, it was really unique that the people behind chip stop and stock investing decided to put a portfolio of chip stocks together.
I will give them credit for this. They are the one team that viewed this as a great marketing opportunity for their YouTube channel, and they nailed it.
They did. They did. And check it out. They've got some great
It is
content.
really great. We should we
Great.
should we should connect with them again and have one or both of them on the show.
Yeah,
All right. I think that's it, man. I think we covered the contest pretty thoroughly. We'll do it again in a couple months.
we did. I'm proud of our listeners doing great work back there. They are very proud of Mitch Fatel. Mitch Fatel, good luck cutting your meat, buddy.
Yeah, we should let him know what he picked.
Yeah, I'll reach out to his publicist.
Yeah.
I'll send him.
Have your people call his people. Let him know
I
what his
will.
stocks are.
I will. I'll have our social media intern contact us publicist. That's what I'll do. All right, Jeff, we have done it. You are correct. All right, everybody. Always like to remind you, we love giving our insights, giving our answers to the hard questions about investing, personal finance, picking stocks, and more. But you got to figure out your own answers. Some of you have figured it out, giving us some great portfolios to get in the contest here. But you got to do more than that. You got to manage your own decisions, own them, and you're going to find your own path to financial success. I believe in you. You can do it. All right, Jeff, we'll see you next time.
See you next time.